Good morning, everybody, and welcome to the Daily Energy Markets Podcast, the new season 24-25. And we thank all of our great commentators for returning. We kicked off yesterday, of course, with the first Sunday of the month, as we always do, with Mike Muller and Christoph Ruhl. And today, as always, Monday morning, Omar Najia, Global Head of Derivatives at BB Energy. Omar, obviously, it's been 2 months since we've had a chance to catch up on the markets. You would say a lot of noise in between. Has a lot changed? Is $80 Brent now a ceiling instead of a floor when we went into the summer holidays? Your thoughts on reflection and where we go from here?
Look, I think basically, if you look at the market, there's a low. I tend to look more on WTI than I do on Brent, but it trades at a differential, so you can just extrapolate the numbers. So we have a low back in 2023 at around 67.70 plus or minus on WTI. And as long as we stay, market's printing $73. As long as we stay above that level, above 67.70, then I think the market is a buy. You buy and you put your stop at just below that low. And the reasons for that are many. It's nothing to do with counting cargoes and supply and demand, and this is +7 and this is +10 and all this kind of stuff. So the reason is, one, I think that markets in general are inflationary. I think, obviously now the Fed said they're going to cut. I think they will keep cutting. I think the US dollar is weak, as we've been saying for a very long time. I think the US dollar will get weaker. And if you look at, so that's one part of it. If you look at positioning in oil, and positioning in oil is basically not just a futures market, but it's a financial market much more than it is a kind of physical market, like by mile. So if you look at positioning is negative, and positioning has been negative for quite a while, and positioning is negative in a big way. So basically, it's like you've got like dry tinder, and you're looking for some kind of match. That match does not have to do with, or does not need to be geopolitical, but it just needs people to rush to the exit, and they're going to all rush together, and they won't be able to fit through, et cetera, et cetera. So as long as we hold this, 67-70 line basis WTI, then I think upside. I think basically risk is to the upside.
Let's welcome back Mukesh Sadhev, Senior VP, Head Oil Trading and Downstream Market Analysis at Rystad Energy. Mukesh, you guys put out an alert at the end of last week with up to 16% of European light sweet imports under threat due to the Libyan unrest. The market decided to ignore you and to fall. What's going on?
Good to be back, Sean. I'm dialing in from the Perth. I will say that it's not just that. Market is probably ignoring a lot of other things, right? The fundamentals are where they are, but there is a lot of bearish sentiment, which has been, I guess, driven by the algo tradings or some of those. I would say that indeed the Libya outage particularly has impact from a light sweet market perspective for sure. But probably, I guess that there has to be a little bit more extension of those outages, right? For a longer period of time. These days, the market does not take any short-term outages very seriously. So that's maybe one of the reasons I could put. But overall, I believe that we have seen, because of the Libya outages, the Brent M1, M3 crude structure backwardation jumped to 2.56. That to me is market is also listening. So not the flat price per se, but the crude structure is certainly moving along with the market. And I think these days, instead of like Omar was mentioning, I remember last time, Omar, when we were here, there was a lot of bullish sentiment going there. And I think I maintain that more than the price level, 80s is kind of the Brent is probably, as you, Sean, you're starting to say, is okay. But it's the crude structure which the Saudis want to watch. And if the crude structure backwardation is decent, then they will think of bringing some barrels back. Otherwise, we are back to where we were.
Let's welcome Arne Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Arne, in the third quarter, we've seen, which obviously starting July 1st, oil prices on Brent are down $10. Not a straight line, but ultimately down, and some serious sort of volatility, you'd say, in August. Is this just a period of the silly season, low liquidity, traders at the beach, and now normality will return? What's your thoughts on the market as we kick off September?
First of all, there's of course a lot of intraday volatility. But if we look at sort of a traded volatility, it's not spiking. That is more in line with what we also saw in equity markets. Things have calmed down after the sort of sell-off a month ago. In my view, there's I think also Mukesh pointed to it, there's a relatively tight market here now. We see that in the market structure. The DFL is positive. The prompt spread is in backwardation. WTI Midland is very expensive as light crude oil, and so on. We have relatively small inventories in the US, so that's a tight market. It should actually speak in a higher flat price. In my view, the market is very forward-looking. At the moment, they are looking forward to Q4, where we have a seasonal drop in demand, and it doesn't help when OPEC seems to be ready to go on with adding more oil. They have chosen the volume button. I put out this small piece thing. They have two choices here. They have the volume or they have the price, and it's apparently they're choosing the volume. And in that environment, oil will be under pressure. And of course, the big elephant in the room here is China. China is slowing down. We saw the PMIs here over the weekend. We've seen some very benign low import data and so on, and the rate cuts from the Fed and the ECB and so on cannot really make up for that. So I think this is driven by outlook for Q4. And it's not driven, I don't think it's driven by erratic, low liquidity trading.
Omar, once again, you've been right in calling that the Fed has no choice but to cut interest rates, even if the gold price is telling us that we're going to have to live with the inflation. But as we come out of summer, you've always said that these markets are driven by sentiment, not any particular. What's the sentiment going forward now in terms of what's the North Star for this market, or for your perception of this market?
Okay, so so I think basically all markets trade like financial assets. They have nothing. I mean, in my opinion, they have very little to do with demand and who's buying what and all this kind of stuff. In any case. If you look at net length on Brent, it's the lowest since, I'm looking at a chart here, 5 years, so 2019, lowest ever since 2019.
Say that again. The
net length in Brent is at the lowest level it's been since at least 2019. Net length in RBOB futures, lowest since 2019. ICE gas oil net length lowest since 2019. Heating oil futures lowest since, well, there was a point at 2020 when it was lower in March, but apart from that, 1 point lowest ever. So if you look at markets like that, if you look at basically oil prices, and then you forget about, you kind of forget about all the fundamentals and technicals, all this kind of stuff. Oil right now is cheaper than it was, let's say, 10 years ago, right? Cheaper. Inflation has skyrocketed from 10 years ago, right? The dollar purchasing power has fallen off the cliff from 10 years ago, right? The Fed, all it's going to do now is cut interest rates. And it's doing it for a myriad of reasons, basically because it needs to finance the deficits, and it can't finance the deficits by increasing interest rates. And interest rates are still growing at 3% a year, right? So that's, you had a 20% and now you have 3% on that 20%. So if you look at markets like that, if you look at the S&P, which I think will correct a little bit and then, head towards 6,000. if you look at gold, if you look at Bitcoin, if you look at any kind of financial asset commodity, I think all the grains now, very interesting, all the grains, corn, wheat, soybeans have, I think, found their low. This is like a multi-year low. So one of two things is likely to happen. And you look at the US dollar, which basically ended a 12-year cycle when it printed those lows on the euro and GBP, about 95 and 103, and now we're at 130 GBP, and we think that 130 is going to go to 2 over time, and we think the 110, 111, 112 on euro is going to go to 170. So if you look at all that, either all that picture is completely wrong, and we're going to have basically deflation, markets are going to crash, the Fed's going to do nothing, and we have to pay for being having basically these massive deficits, and everybody's going to rein in spending. That's one possibility. The other possibility is they're going to just open the spigots like they did in 2008, and then they opened the floodgates in 2020, and they haven't shut them, and they're now going to open them even more. So you can tell just by the stuff that you're paying. So I went to buy like a pack of bacon when I was in the supermarket. I remember bacon. I was paying 36 dirhams for a pack. Oscar Mayer, it was at 52. So you're telling me basically the price of everything I see, everything, house prices, education, taxis, trains, planes, water, coke, coffee, everything is going up. But I'm going to take a strategic decision to take this company money and bet short on oil. I'm not doing it. So I'm not doing it.
The Omar's Bacon Price Index, that's the new one as compared to the Big Mac Index. Mukesh, I came across this amazingly bright person on the LinkedIn asking a key question. His question is, oil markets will tank further again and lose recovery from the recent financial market sell-off, or tip towards strength with unexpected constructive fundamentals ahead? Key question, tank or tip towards strength? Of course, I'm being a little bit facetious because, of course, you asked that question on your post on LinkedIn, and I'm putting it right back at you to answer it for us here today.
Good question. I think this is what I'm pondering over because everywhere I go and meet our clients, and whether the markets, there is a fear of tank or tip toward the strength. I think my answer, Sean, is hold tight. Now the markets will hold tight near these levels. There are many bears in the market, like China demand, but there is only one bull in my view, which is the OPEC, and OPEC is in a very strong position. Not just because of the cuts, because they are putting a lot of emphasis on the compliance as well. But OPEC is also countries, Middle East countries are very strong on the downstream refining side, product market flows, right? So when they have the handle of cutting the crude or cutting the product exports, I think they will be able to ride through the market, keep the market in backwardation, hold tight around kind of the 75 and 80s levels. They don't want 90 plus in my mind, because that triggers non-compliance and unity is disturbed among those members. Similarly, they don't want a very low oil price either. And in that sense, by either cutting the products or by cutting the crude, they can be able to hold. Now, the key thing, Sean, which I want to put out is that we have been saying, and we have been getting it right, that despite the temptation in the summer to bring the barrels, they cut and they extended the cuts. Going forward, I think there is a big...
Sorry, they being OPEC.
Yes, OPEC
Plus.
Yeah, OPEC Plus. Yeah, OPEC Plus as a group, not the OPEC agency. Going forward, there is a strong product overhang emerging, right? Product surpluses, some weakness from demand, but also higher supply side. And that product overhang, and I think as Arne was mentioning, that market is more forward-looking. they are not just fearing the crude side, but they're fearing more of the product overhang. So chances are Middle Eastern countries, big refineries, 2+ million barrels new capacity, could actually decide to cut more product exports to rest of the world to contain the emerging product surplus and then prevent the market from tanking. So I'm in the camp, no tank, neither a tip towards a very high number, hold tight around these 80s levels, once in a while intraday volatility up and down, and then probably wait for the geopolitical system to come its course. The US elections will be decided, and then the market will do some more drastic action. But till that time, hold tight.
Arne, just taking the thesis as I led off with, that $80 Brent, we went into the summer as a floor on the market, coming out of the summer feels more like a ceiling. Whether you agree with that thesis or not, we're coming out of the summer. Has this market changed? I mean, there's been some notable changes in the sense the Fed have finally decided that they're going to start cutting rates. They've signaled that quite strongly. Has this market changed? We've seen a consensus that appear, at least Rystad Energy told us last week, that the consensus now seems to be around a 1 million barrel a day of demand growth in 2024, which is on the very low end of the range going into the summer. Your thoughts on what's changed coming out of the summer structurally for this market?
I think China is an important change. That China has turned out to be weaker on the demand side and the growth side. So that's definitely one point where the market has changed. And then I think that I have actually been a bit surprised that it seems like OPEC is ready to go on with these production increases. When they put forward, I said that they're not going to be able to do this. Apparently they are. Maybe they are saved by the bell by Libya. Who knows? But with China in the back, if we are only talking about 1 million barrels, as the International Energy Agency is also talking about, the OPEC analyst seems to be way off, talking about 2 million barrels of growth this year. So maybe we are in for where 80 is indeed a ceiling for a while, and I think that would be the case until basically OPEC Plus backtrack on the plans to add more oil. I actually thought they would backtrack this weekend, but they didn't. So they So that's my 5 cents. I agree with you for now. 80 is more of a ceiling than a floor, and we're probably talking about the low 70s as the floor for now in the case of Brent. But it's a bit of a conundrum, given that the market fundamentals here now are actually quite strong, no doubt about it. And I agree with Omar that the market is extremely short. They are more sensitive to positive news. But as a wise man once says, the market can remain irrational longer than you can stay solvent. I think that was Keynes who said that. We have to be aware of that. But yes, the market is extremely short. Always have that in mind. And if we get some positive news, OPEC backtrack, it seems like the Libya case drags on for a longer time. Maybe Libya close down completely. I think we could see some upside, at least short term.
Well, there is some noise out of Libya today, which of course is always a bit murky, but the noise seems to be about oil flowing again rather than closing down. At least incrementally, it appears Libya is rehabilitating on some level. Let's go to the survey question, which obviously is sort of anchored in this thesis. Is $80 still a floor for Brent crude, or is it now a ceiling moving into the fourth quarter? Your thoughts on that? It would be fair to say that $80 is, I mean, the average price so far this year will tell you that has been above 80, the average since January year to date. So clearly 80 has been a floor. But in this period coming out of the summer and going into the fourth quarter, is 80 now switching to being a ceiling? Omar, your thoughts on where the U.S., obviously the world's biggest oil consuming economy, the world's largest oil producing as well. But ultimately, as we go into this window of time as we talked earlier, the Fed moving into a rate cut cycle. Usually rate cuts indicate economic weakness. That's why you cut rates, to support economic health and growth, because the economy in itself is looking more fragile. So if indeed the world's biggest economy that consumes the most oil in the world is going into an economic cycle of weakness, is that bearish for the outlook for oil? Your thoughts?
Okay, so I don't think they're cutting rates because the economy is weak. I mean, they're cutting rates with inflation at 3%. Clearly, the economy is nothing, weak is not it. So they're cutting. Things are very much different now. So they're cutting because they need to do a gigantic, a humongous amount of borrowing. Their trade deficit is basically going at a rate of $1 trillion every 3 months. So they need to borrow that money. And more importantly, they need to pay interest on that money. At interest rates as they are now, they're paying over $1 trillion in interest, right? Which is just about as much as they pay for defense and Social Security and that kind of stuff. So it's a disaster. So the Fed can say whatever it wants about the economy. The Treasury Department needs money and needs basically to be able to pay for those loans. So they're going to keep cutting interest rates. They're going to say whatever the market wants. The economy is weak. We've won against inflation. Everything's, we need to cut just in case, blah, 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 blah. But the real reason, and it's not just me saying it, the market knows this. I mean, it's totally obvious to everybody. The US is in a lot of fiscal trouble. All they know how to do, and the West in general, they have massive debts, and the only thing that they can do is print more money and debase the currency. It's not rocket science. So if you debase the currency, and people know that you're debasing the currency, what does that mean? People buy hard assets like gold, hard assets like Bitcoin, hard assets like house prices, hard assets like cars, hard assets like anything. So the US economy's problem is not in terms of weak anything. It's to do with their politicians can't do anything except spend. And when you have an election, nobody is going to say, look, elect me and I'm going to cut back on this and I'm going to increase your taxes and I'm going to spend less on defense. No. They're all going to say with more. So if you look at what they spent during COVID, right, 2020, 2021, that has continued at the same trajectory. So the graph was going like this. From 2008, it went like this. From 2021, it went like this. They're still spending at the same rate. And actually, they're increasing spending. So you can basically, I like to look at things which are basically no-brainers. And it's very true that the market can stay irrational and all the rest of it. But for the life of me, I will not be selling oil at basically these levels on a strategic basis. In other words, I think basically that you sell now, you come back, 6 months, a year, whatever, oil prices are going to be lower and everything's going to be lower. But I do tell you one thing, if oil prices are going to come off, and if basically, quote unquote, China's in trouble. I mean, I think China's been in trouble for the last 50 years, right? I keep hearing China's in trouble, and China keeps growing. And then China's going to implode, and the real estate market, China's going to implode, and it keeps growing, and it keeps growing, and it keeps growing, right? So if any of the doom and gloom, in terms of deflation come to happen, then everybody's head in the West is going to come clean off their shoulders. There is absolutely no hope. The only game in town is inflation. The only game in town is spend more, deflate or inflate your debt away, and debase your currencies. I mean, it's crystal clear, which is why you have the rise of the BRICS and the fall of the West. et cetera, et cetera, et cetera. And you can see it in terms of social moods, and you can see it in terms of the markets. In Weimar Germany, when inflation skyrocketed, what did the German stock market do? Skyrocketed.
As did the American. Mukesh, listening to that and knowing OPEC plus, well, the 8 countries within OPEC that have been labeled as the Great 8 have made this commitment to raise production from October 1st, and it's 180,000 barrels in the first month of their increased program. So how should they assess, as Omar has done in his analysis, this cut of interest rates is not because of economic weakness? So no problem, OPEC Plus can continue with their plans because if there's going to be demand for oil. Your thoughts of the reading for OPEC Plus, not necessarily on price relevance, but on demand relevance for adding 180,000 barrels next month?
Now, I think some parts I agree with Omar, but some parts I don't agree with him as well, right? The parts I agree, indeed, that the world is indeed not tackling weak, but the world is tackling inflation. That part I agree. And when we look at the demand, I think we are lost in the averages, because year-on-year numbers, 1 million barrels per day, looks like our view is also similar. But if you look at the first half and the second half were more weak, and the second half is not 1 million barrels per day growth, is higher than that. So in that sense, my view is, and where I agree with Omar, is that China will do better than what they're talking. I was in China talking to many players in the market, and the narrative was that, Mukesh, your demand growth is very bullish, despite being OPEC as the agency putting out a 2 million barrel per day demand growth. 1 million barrels was touted as bullish. So my view is that China's interest is talking demand down. China's interest is not giving a bullish signal to the market. It is maybe the time to buy some oil, buy the lows, and ultimately China will end up doing better than what they're talking. One example I can give you is that on diesel, there is so much talk around LNG trucks eating diesel demand. LNG trucks, right? There's no hard data, Sean. And I think the only hard data which we looked into the balances, and we found that maybe out of the 3 million barrels per day of diesel demand, it's maybe a 50 or 100 KBD impact. So there is a lot more bearish narrative that comes out. Ultimately, China, in my view, in our view, might actually do better. So I would not be saying here that the market will tank. I would say that market will also not go crazy unless some geopolitical happens. So back to your point, the 80 floor, but the most important is keeping the market backward. It is OPEC plus #1 goal. And if they bring some crude back, they will pull back the products from the market. And that's how they can still balance and give some room to the crude to come back, but still hold the backwardation.
Arne, last word to you, and we'll take the survey result as well. So ceiling rather than floor, not by much, still a somewhat divided viewpoint there. When you think of the different factors coming into play, we have obviously the OPEC supply increase, which, Bloomberg and Reuters, as they write up their daily commentary on the markets, that's the reason why oil prices falling today. Last week, well, it was Libya losing production, why it's rising. But ultimately, going into the fourth quarter and going into the sort of post-summer period, geopolitics are still very strong front and center. The war in Ukraine, the war in Gaza, and of course the big US presidential election. Does that factor in without it sort of blowing up an oil pipeline or blowing up actual oil infrastructure, but that geopolitical backdrop, does that give this more of a $80 floor feel than an $80 ceiling? Your thoughts on the role of geopolitics going into the post-summer period?
I actually believe at the moment the geopolitical premium is actually relatively muted. I think the market is getting a bit laid back, saying, okay, what's going on in the Middle East is terrible, but it will not evolve, it will not spread into Iran, so no oil will be involved. The same goes on in Ukraine. It's terrible, but it seems like Russia is able to continue selling products into the market. Let's see if Ukraine has a bit more luck there. But I actually think Libya is quite interesting. I think what's going on is actually also that maybe they're producing a bit for their own demand, but not for export. But let's see. It was 9 months in 2020. This could drag on for a while. But it is a bit like with the positioning, the speculative positioning. It's very low. I also think that the geopolitical premium is quite low at the moment. So I actually believe that the geopolitical premium adds an upside, creates more than 80. Is more of a, in that respect, is more of a floor than a ceiling. Will it be enough to bring it above 80? I'm not so sure, given the sort of the more supply and demand outlook for Q4.
Well, there's certainly a lot of things as we come out of the summer to weigh up. And it is a little bit extraordinary that in some regards, with US printing 3% GDP growth last week for the previous quarter, for geopolitical, as whether risk premium or not, China's still doing decent. 700,000 barrels of Libyan crude out of action, and yet the oil price is muted in well below $80 Brent, when you would think all of those factors would be lifting. What's going on in the weakness side? Just because OPEC Plus plans to add 180,000, it's not even a quarter of what is knocked out in Libya. So I think a lot of factors to wash out here as the traders get back to their desk and the market wakes up after the summer to sort of balance out all of these factors. And I think perhaps that will start to give some clearer direction in the coming days. Today is obviously Labor Day in the US. So New York the Wall Street doesn't really get back to work until tomorrow. And then maybe some clarity arise. Until then, we say thank you to the great Omar Najia, Global Head of Derivatives at BB Energy, Mukesh Sadhev, SVP, Head of Downstream Oil Trading for Rystad Energy, and Arne Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Thank you for your insights today. Thank you for being part of this new season. We look forward to catching up with you all again soon. Take care.
Thank you, everyone. Thanks, Sean.
Thank you.
Cheers.
Bye-bye.